In fact, the choice between paying off debt and investing could have a massive long-term impact, possibly amounting to hundreds of thousands or even millions of dollars. Understanding the trade-offs can mean the difference between financial struggle and financial independence. Laying the groundwork, build a financial foundation first. Before diving into whether to prioritize debt repayment or investing, it's essential to first build a strong financial foundation. This means creating an emergency fund that covers at least 3 to 6 months worth of living expenses. This cash reserve acts as a safety net for unexpected situations, such as job loss, medical bills, or urgent home and car repairs. Without an emergency fund, a single surprise expense can derail your financial progress. Imagine aggressively investing or throwing extra money at debt only to be forced to use credit again or sell off your investments because your car breaks down or you lose your job. In that case, you'd be back to square one. Advantages of paying off debt. Once you've secured your emergency fund, focusing on debt repayment offers several compelling benefits. 1. Improved cash flow. Paying off debt reduces your monthly financial obligations. With fewer bills to pay each month, you'll have more room in your budget. This breathing space can make it easier to handle day-to-day expenses and allocate money toward other goals like investing or saving for a major purchase. 2. Less financial stress. Being buried under loan payments can feel overwhelming. When multiple debts, student loans, credit cards, car loans, pull from your income every month, it can feel like you're working just to stay afloat. Eliminating these obligations can provide a significant mental and emotional boost. Third, guaranteed return. Each dollar you use to pay off high-interest debt guarantees a return equal to the interest rate on that debt. For example, paying off a credit card with a 20% interest rate is effectively earning a risk-free 20% return. That's a solid deal, one that's often better than any investment on the market. Fourth, easier retirement planning. Once you're free from debt, it's much easier to ramp up your retirement contributions. With more discretionary income available, you can start or increase investments in retirement accounts, which compounds your money even further. Advantages of investing. On the other hand, choosing to invest instead of paying off debt has its own advantages, especially when the debt carries a relatively low interest rate. 1. Higher potential returns. The stock market, over long periods, has historically returned around 10% annually. If your debt has a 4% interest rate, you might come out ahead by investing the extra money instead. This spread between borrowing cost and investment return is where wealth can grow substantially. 2. Compound interest works best with time. The longer your money is invested, the more opportunity it has to grow. Delaying investment contributions, because you're focused on paying off debt, means potentially missing out on years of compound growth. Over decades, this missed growth could result in a significantly smaller nest egg. 3. Diversified asset growth. Investing opens the door to a variety of assets, stocks, ETFs, real estate, mutual funds, that can build long-term wealth. While debt repayment is important, once your financial obligations are manageable, investing early can help your money grow exponentially. Weighing the risk. Perhaps the most crucial factor when making this decision is understanding and evaluating risk. When you pay down debt, the return is predictable. If your loan carries an 8% interest rate, paying it off is like earning 8% with zero risk. That's hard to beat in the investing world, where returns are never guaranteed. Markets fluctuate, sometimes wildly, and your investments could lose value in the short term. Historical data backs this up. While the S&P 500 has averaged over 10% per year since its inception, it hasn't been a smooth ride. For example, between 2000 and 2002, the S&P had 3 consecutive negative years: negative 10%, negative 13%, and negative 23%. Then again in 2008, it plummeted by 38%. These losses were painful, but they were followed by significant gains in the years that followed. So while the odds are generally in your favor when investing long-term, the risk is still very real, especially if you need to withdraw money during a downturn. In contrast, reducing debt locks in a return, removes financial burdens, and lowers stress. A real-life comparison. Let's explore a hypothetical but practical scenario to highlight the difference. Scenario 1. Paying down a mortgage. Suppose you have a 30-year mortgage of $350,000 at a 4% interest rate. Your monthly payment is $1,671. You also have an extra $1,000 each month that you're thinking of using either to invest or to pay down the mortgage early. If you apply that extra $1,000 toward your mortgage, you'll pay it off in about 14 years and 5 months instead of 30 years. That decision would reduce your total interest paid from $251,544 to just $110,799, a savings of more than $140,000. Now, once the mortgage is paid off early, you can begin investing the full amount you were previously spending on your mortgage, $2,671 per month for the remaining 15 years and 7 months. Assuming a 10% return, your investment would grow to approximately $1,203,916 by the end of the 30-year period. Subtracting the $110,799 in interest paid, your net financial gain would be $1,093,117. Scenario 2. Investing from the start. Alternatively, you could stick to making only the minimum mortgage payments and invest the $1,000 monthly from the very beginning. Over 30 years, that investment, growing at a 10% annual return, would total around $2,171,000. However, you would pay the full $251,544 in mortgage interest over the 30 years. Subtracting that from your total investments leaves you with $1,919,456 in net gain. Conclusion: by investing early instead of paying off the mortgage, you end up with $826,339 more at the end of 30 years. That's the power of compounding working in your favor over a long time horizon. Inflation, the hidden ally of borrowers. One of the less obvious factors in favor of carrying low-interest, long-term debt, like a mortgage, is inflation. Inflation gradually erodes the purchasing power of money. That means the fixed monthly payments on a 30-year mortgage become easier to afford over time. If inflation averages around 4% per year, the value of a dollar gets cut in half roughly every 18 years. So the mortgage payment that feels hefty today will seem relatively minor in the future. Meanwhile, if you're investing in assets that keep pace with or exceed inflation, you benefit twice. Your investments grow in real value, and your debt becomes cheaper to repay over time. Why mortgages are a special case. Mortgages are a unique type of debt for 2 key reasons. 1. Low interest rates. Mortgage loans typically come with lower interest rates than other types of consumer debt. When rates are close to inflation, it essentially means you're borrowing money at little to no real cost. Second, long-term horizon. Because mortgages often last 30 years, the compounding effect of investing instead of prepaying can be substantial over time. This long time frame magnifies the impact of your financial decisions, whether you choose to pay off the loan early or invest. That's why some financially savvy investors actually prefer to hold on to their mortgages and use their extra funds for investments with higher expected returns. What should you do? A balanced approach. Ultimately, there is no one-size-fits-all answer. Choosing between paying off debt and investing depends on your goals, income, risk tolerance, and stage of life. Here are some key takeaways. High-interest debt should be paid off first. Credit cards or personal loans with rates above 10% are extremely costly and should be eliminated quickly. Low-interest, long-term debt like mortgages may not need to be paid off aggressively, especially if you can invest for higher returns elsewhere. Cash flow matters, especially later in life. Older individuals nearing retirement may prefer paying off debt for peace of mind and improved monthly budgeting. You don't have to choose only one. A hybrid approach, splitting your extra income between debt reduction and investing, can offer the best of both worlds. Every financial decision comes with opportunity costs. The key is understanding both the risks and the rewards and making informed choices based on your situation. The numbers provide a framework, but the ultimate decision lies in your personal financial philosophy and goals.